In the last 5 trading days, the British pound has lost approximately 4.5% of its value against the US dollar, pushing the currency to a multi-year low. Only once since 1985 has the pound been lower against the dollar. Now, most analysts would agree that the primary driver of the pound's weakness is the dramatic change in Federal Reserve expectations that has pushed the dollar higher against most currencies, but particularly the pound. Now, for comparison, the euro and the Swiss franc were down only 3.5% and 3% respectively in the same period. Perhaps the market is expressing concern over the uptick in UK unemployment, or perhaps it's related to a referendum on Scottish independence. Now, this, of course, comes at a time where inflation is extremely high and the conflict in Eastern Europe is driving up the cost of food and energy disproportionately throughout Europe. Now, the CME offers 3 different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. For these examples, we're going to be using the micro. If a trader believes that the British pound will continue on its path lower, they could express that by selling the September CME micro British pound futures contract at 1.2088 and target a move to the 2020 lows of 1.1500. Now, a stop for this trade could be placed above at 1.2300. This trade could make $367.50 if your target is reached and risks $132.50 if you're stopped out at your level. Now, if a trader believes that the British pound will retrace its current weakness, perhaps on a Bank of England pivot to a more hawkish inflation policy, they could buy that same September CME micro British pound futures contract at 1.2088 and target the late May highs of 1.2650. A stop for this trade could be placed below at 1.1800. This trade could make $351.25 if your target is reached and risks $180 if you're stopped out at your level.